Good. That brings us to 5.2.6. The company increased the share capital by 840,000 and the loan by 550,000. And you've got to explain how this is affecting the gearing and the risk of the company. Quote two figures. Now, the first one, the one that we determine risk and gearing, would be the debt equity ratio. Let's just go and look at our formulas. Now, the debt equity ratio, the one that we calculated earlier, it measures the degree of financial risk of the business. What this debt equity ratio basically does is it compares the outside debt, in other words, the loans, to the inside capital that we acquired by selling shares, our shareholders' equity. So the more loans I've got, the more risk I'll have, because if I can't pay it, they can close down the company. So I want this ratio to be as low as possible. The non-current liabilities must be a very low percentage in comparison to the equity. And with that, I will then measure the degree of risk of the business. There they say the lower the ratio is more favorable, the business is less of a financial risk. They also say the lower geared, the lower that ratio is, the lower geared we are, and that will be less of a financial risk. If you haven't got that many loans, it's also easier to obtain loans. And a high ratio indicates that funds have to be obtained by other means besides borrowing. So if you've got a very high ratio, you won't get loans that easy. So you'll have to find other means to get capital. So the first one I will look at is the debt equity ratio and see what happened to the debt equity ratio. If I go back down, the debt equity ratio was 0.121. We calculated the new equity ratio. Let's just see what that was. The new debt to equity ratio was 0.18 to 1. So the debt equity ratio increased from 0.1 to 1 to 0.18 to 1. But it is still very low. So I will put there in my answer, the debt equity ratio increased from 0.1 to 1 to 0.18 to 1, but it is still very low. The company is still very lowly geared, so they will still be, they won't be in financial risk and would be able to acquire loans fairly easily. So just compare the two, and then if it is still very low, although it went up a bit, it is still extremely low, so you're not at risk. So, but you can say there, you compare the 2 years, it increased, but it is still very low, so the company is not at financial risk and would obtain loans very easily, because that is what they ask you in the question. You've also got to mention a second one. We can then look at the return on total capital employed, or the ROTCE, ROTCE, return on total capital employed. And that was also one that we calculate. No, we didn't calculate this one. They say when we do that, we compare it to previous results, see if it went up or down, and then also compare it to investments such as a return on a fixed deposit. So what this is, it is telling the owners the net profit equals a certain percentage. So their investment that they made in the company is giving them so much return, a percentage return. Now, if I put money into a place to invest, remember, if you buy shares, you invest, you want to make sure that that investment is doing better than what you could do elsewhere, and especially a fixed deposit. So if I'm getting much less than I could with a fixed deposit, where I haven't got any risk, I would rather put my money on a fixed deposit. So we're going to look at the ROTCE and see what happened to the ROTCE between the 2 years. Okay, this you want to be as high as possible, because remember, it's your percentage on return on your investment. So you want as much as possible. So if it decreases, it's not good. So my ROTCE last year was 14.4%. This year it is 12.9%. So it decreased by from 14.4 to 12.9. So I would say the ROTCE is my second one. Decreased from 14.4 to 12.9, which is not good. It is also a very low percentage. If you compare that to outside deposit, if I look at what the interest is that we pay on loans, it is 13.5. So we're paying out more interest on loans than what our return is. You want to make more money than what you pay out. So that is also indicating that they are not getting enough profit on their operation, and for it's costing them more money in terms of loans, 13.5%, than what they're making. So they will have to make a plan to make better profit. Good. So let's look at the next one. Just make it smaller a bit. Good. The next question. The directors decided to decrease dividend payout percentage. Remember that when they pay out dividends, it is a percentage of the profit. They do not pay out all the profit as dividends, as that would be reckless. They need to keep some back for the operations in future as working capital, and to cover whatever expected expenses there may be. So it is a management decision. So what the directors did, they decided to pay out less. They decrease the percentage. Now you've got to provide calculations to show the change in the payout rate. Good. To calculate the payout rate, we need to look at that is what we earned, our earnings per share, and that is what we paid out, our dividends per share. So we must work out what percentage that we pay out as dividends of what we owned, and do the same for this year. So last year, our dividends per share was 80 cents, and our earnings per share was 83. So you can see we paid out quite a large percentage of what we made. So let's just quickly work that out. Okay, so our dividends per share. So to work out, we will take dividends per share divided by earnings per share. And that answer we must then just multiply by 100 to get to a percentage. So my dividends per share for the year, for last year, was 80 cents, and my earnings per share, 83 cents. So it's 80 divided by 83 times 100 over 1, or 100. And that gives me 96.4%. So they paid out 96.4% of whatever they made. This year, it was my earnings was 71 and my dividends 47. So much less percentage that I'm paying out. So 47 divided by 71 will give me the percentage. 47 divided by 71 times 100, and that gives me 66.2%. So there you can see why they say they're paying out much less. This year, paying out 66.2, last year 96.4. So let's see what further we must answer. One reason why many shareholders were satisfied with the change in policy. Quote figure. So let's look at the figures. Why do we think the shareholders would have been uh, happy with the decision? First of all, if I look at the net asset value, it increased from 816 to 837,000. So that would the net asset value per share. So the net asset value went up quite a bit, which means shareholders would feel yes, it is a positive thing. It will generate income in future. Also, the market value per share went up from 807 to 840, uh, which is a 33 cents increase. So people that had bought shares, will now get 840 cents compared to last year's 807 cents. So it is showing that the retaining of money was for capital growth. Uh, we can also say that the shares most probably went up because the retained income balances went up. Last year that was 141,500, and this year we calculated it's a 311,000. But stick to what is on the table with financial indicators. The big indicator that they are happy is the increase in share prices and also the increase in the net asset value. That shows that shareholders are fairly happy with the decision that the directors made. Then they tell me on the 1st of March, Martha owned 475,000 shares in the company. She did not purchase any of the shares that were issued on the 1st of May. Explain how the repurchase of shares benefited Martha's shareholding. So let's look at the information. Good. So the total shares after the buyback, we started off with 900. Additional 100,000 gave us 1,000,000, and now we bought back 60. So the number of shares in issue at the end would be 900 plus 100 minus 60, which gives me 940,000. So, and of that, I've owned, according to the note, 475,000. 940, 400. Good. So we must now just calculate what her percentage shareholding is. So she's owning 475,000. The total number of shares in issue is 940,000. And so to work out her percentage percentage of shares, we simply divide whatever she owns by the total and multiply that by 100, and that gives me 50.5%. So after the buyback, because before the buyback it was 1,000,000 shares in issue, then she had less than 50%. Now after the buyback, she's got more than 50%, and if she's got more than 50%, it makes her the majority shareholder. So certainly she will be very happy. Good, so go and look at some of the questions and try and do the rights, etc., and see how it goes. Good luck.